Welcome back to the Nasdaq PHLX options trading floor. I'm Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live with Shawn Cruz. He's the manager of trader strategy over at TD Ameritrade. It's been quite an interesting session. We're going to get into some macro stuff, but let's get a quick market update. We had Williams speaking. The market rips 30 handles, dropped almost flat, and then up another 10 handles. It's like it's a little bit erratic today, as it has been all week.
There's some massive swings in sentiment going on, and we've gotten some interesting economic data out. So we got the PCE, which is the Fed's preferred inflation indicator, that came in a little bit below consensus, a little weaker than what was being expected. So it's coming in around 1.8 or 1.9%, below that 2% target that the Fed has. We also had consumer sentiment data come in that showed a little bit of strength, and we also had a retail report put out by the Commerce Department saying November was actually pretty strong from a retail standpoint. So there's a lot of data coming into the market when you do have quad witching going on, which does increase volumes across the board, but we're still at a time of year where you're not going to see too many buyers or sellers coming in aggressively just because of the timing around the holidays. So I think that really makes the market prone to some of these intraday swings. So I expect this to play out throughout the day.
Oh yeah, and I would imagine throughout the week, next week as well, because with lower volume, the moves are going to be exacerbated with liquidity drying up as well, as we've been talking about.
And if you look at what the VIX is showing you right now, the VIX up around 27 or 28. That I would expect these kind of swings when you're looking at an index like the Nasdaq that's around 2,500 points. VIX at 27 or 28, I would find it more odd if we weren't getting these massive intraday swings with a VIX at the level that it's at.
All right, let's talk a little bit of macro here, and there's been plenty of data points to talk about this week in addition to the news cycle that we've been taking a look at. But one of the indicators that you use when looking at different commodities such as gold, energy, what have you, is looking at the futures. Because you have your spot price, which is telling you what it's doing right now. But if you want a forward look, traders should really be looking at futures as an indicator.
Well, yeah, exactly. And that's something we've seen a lot of interesting developments. If you want to just take a prime example, is crude oil. And we start to look at crude oil, the futures curve, and that's where we can look at the price for crude oil at different delivery dates going out in the future. And the shape of that curve, where we look at, are the front month prices higher than the back month? That's called a backward curve. Or are the front month prices lower, and you get an upward sloping curve? That's called contango. But it's interesting in how that manages the supply and demand in the crude oil market. So for a little bit, we saw a little bit of a concern about shortages in the near term in crude oil. And so what you saw was the front end of that curve, the shorter dated futures, get extremely elevated relative to the further out futures contracts. And all that is the market trying to right size and balance supply and demand. By bringing up the price in those front months, they're trying to get oil producers to bring more supply on sooner rather than later. And that's how the pricing mechanism really works in balancing out supply and demand. And what is a pretty complex global economy, and a lot of suppliers, a lot of in-demand users, and then there's just everything in between that exists in the oil ecosystem. So it's an interesting phenomenon to see play out, and it really shows the power of markets and pricing in just a lot of different factors into one single price. But it's not just crude oil, we see that, and you can see that play out in gold. I think lately gold's been a little bit more of a relative play to what we're seeing in movements out of the dollar, as you get changes for what the Fed's going to be doing, inflation and growth in the U.S. That's all caused a little bit of an ebb and flow between the dollar and gold.
Which is really interesting, because you think we'd hear more about gold, considering how unstable the environment feels right now. But it's been kind of in the back burner, kind of a quiet story right now.
We've seen it since the Fed announcement this week. Initially, it was interesting that you saw the dollar and gold actually move in the same direction.
And that's not typical. They're usually inverse.
They're usually in the opposite direction. But that did correct itself, where we actually saw the dollar selling off yesterday, and we saw the price of gold continue to rise. And I think that's a little bit of a statement about the perception of the market that the Fed may be a little bit more dovish, which weakens the dollar. But when you look at that as maybe a potential driver of inflation, what's a popular inflation hedge? Well, that's gold. So you saw the dollar back off as the concerns about inflation eroding the value of the dollar started to play out there. And then you saw people who view gold as an inflation hedge go in and start buying gold, and that pushed the price of gold higher. So that relationship was a little off on Wednesday, but certainly corrected itself in a big way Thursday and even into today.
Would you expect to see, in addition to the dollar, FX have a lot of movement, because there seems to be a lot of political uncertainty out there, a power vacuum created, even more so. So I would imagine that there's going to be fluctuations around this as we maneuver through Brexit, as the EU becomes a little bit more fragmented.
I think you always want to look at the pairs. because if they do become very interested in how they play out, you've seen that play out in Brexit, where there's been a little bit of weakness in the pound, and you see that currency pair trading in a little bit more of a distinct manner from what we're seeing out of the Eurozone, where initially we were just focused on Italy, and now we've heard France sort of come into the mix as well. You had an interesting development in Germany with the elections going on, so there's a lot of uncertainty being priced into some of these currencies overseas.
Right.
The other interesting is the yen. So the yen is viewed sometimes as a safety play. When you start to see a lot of concerns focused in the Asia Pacific area, they actually move into the yen as somewhat of a safe haven currency for that area. But then there's also just the interplay between the US dollar and the yen. So there's always a lot of ins and outs of the currency markets, and it is interesting to see how you get those macro effects priced into the various currency pairs. So it's very important to understand what is moving that individual currency relative to the other one, and that's where a lot of those geopolitical factors come into play, and understanding what they are and how they're going to affect local economies.
Right. I mean, the U.S. Japanese yen pair is a big indicator that traders use, particularly when analyzing the equity markets.
They do, and I think when there's a lot of what's considered the carry trade, where you just see incredibly lower rates for the yen and you see elevated rates for the dollar, so that makes some traders want to go out there, borrow in yen, translate it to dollars. When you start to see a lot of nervousness out of U.S. investors, they start to do what's called unwinding that carry trade, where they start selling their dollars and going out and buying yen to close out those positions, and that puts downward pressure on the dollar and upward pressure on the yen. So that's another way where you see uncertainty or just a little bit more of a risk-averse theme coming into the market play out, is watching that U.S. dollar-yen pair.
And it's all great points that these are other indicators that you can use just besides what you're seeing on the charts.
Yes.
And I agree with you that the traders need to look at that as they review their overall trading plan. It's not just fundamentals, not just things you see on the charts, but there's a number of different kinds of indicators that you can use.
Yes, and every trader, I think, has their own system where they start to learn, and here's what I'm looking at, here's how I see what is going on in the markets playing out in my chosen indicator. But I think it's one, you never want to focus on just one,
right?
Because there's always there's plenty of different ins and outs to what drives these various indicators. We just highlighted a handful of geopolitical issues that can play out in the currency markets, but I think it is important to pay attention to these currency pairs, especially now that a lot of the tensions that are driving volatility in the markets are being played out on the global front. So you want to track those currency pairs, because that's really where you see markets playing out, where they're positioning their assets and putting them to work.
All right, Shawn, thank you for all the insight, and thank you for joining us. We're coming to you live from the Nasdaq PHLX options trading floor. I'm Jill Malandrino, Global Markets